Good morning and welcome to this Wednesday edition of Inside India. I'm Sri Jegarajah. Here are your headlines. China's first quarter GDP beats estimates, but the expanding trade war is keeping a lid on market sentiment. Gold prices go from strength to strength, hitting fresh record highs as investors search for safe havens. And India's latest retail inflation data falling to a near 6-year low, which may give the Reserve Bank of India more room to manoeuvre in this uncertain environment. Welcome, everybody. Midweek and the Indian markets join us in about 45 minutes' time. Let's take a look at Gift Nifty futures to see what they are indicating for the open. And we are looking at a move to 23,282. So where we left off yesterday, and you contrast that at 23,328, we are looking at some weakness, relatively mild weakness at that. A dollar India rupee rate is at 85.6550, stable at that level. Let's take a look at the Asian markets and how they are performing in the broader region. It is quite a mixed bag, and the market continues to wrestle with a tariff flip-flop, a tariff uncertainty. The TAIEX is the loss leader at this point, down by almost 2%. Similar story for the Hang Seng Index, down 2%. But there are some bright spots, including in Australia and New Zealand, up just marginally, though. But once again, this is a story of caution given this evolving tariff environment and the uncertainty that it brings with it. Let's move on to the data. And China's first quarter GDP providing some relief today, but the trade uncertainty looms large for the world's second biggest economy. Emily Tan joins us now. Emily, so 5.4%, but is that sustainable?
Yeah, that is a very good question. And with the huge tariff risk, the unprecedented challenge that is now faced by the Chinese economy, 5.4% coming in for the first quarter. And that, of course, is also very rear-looking. So it's the rear-view mirror, and that compares to a 1.2% growth quarter on quarter. So this is the reading for China's economy. March retail sales at up 5.9%, better than expected. March industrial production up 7.7%. Also coming in better than expected. Fixed asset investment up 4.2% for the first quarter. We're looking at the unemployment rate at 5.2%. A lot of commentary coming through with the Statistics Bureau talking about the Q1 data underscoring China's strong resilience and potential, that protectionism is rapidly rising globally, and that the world economic order has been severely damaged. Resolutely opposing U.S. tariffs, which are against economic rules, the WTO rules, and that high U.S. tariffs will bring about some pressures on China's trade and economy. U.S. tariffs will not change the long-term improving trend of China's economy, it says, and that macroeconomic policies will become more proactive this year. China issued nearly 1 trillion yuan in special local bonds in the first quarter that helped to boost investment, and they're going to be taking measures to promote reasonable rises in consumer prices. It is crucial to keep consumer prices within a reasonable range, it says, and it adds that the property market continues to improve in response to policy support. So that is what the expectation is, a policy support which needs to be brought forward given the accelerations of the policy implementation in response to what's happening in the trade front. Pull up some stocks. If we do have some domestic demand plays, we are tracking the likes of Meituan, Nongfu Springs, Anta Sports, and even New Oriental Education, all traded in the Hong Kong market. And we're looking, of course, that being kind of a proxy for the Chinese economy. Nongfu Springs, which sells bottled water, the shares down 3.3%. So we are tracking all this data, Sri, which has come in better than expected. But the market is very cautious and hesitant because this does not reflect anything in terms of the trade war, the Liberation Day, as it's being called by President Trump, because, of course, April the 2nd, we are living in a whole new world. Sri.
And that's why 5% could very well be at risk in future quarters, but notwithstanding Stats Bureau messaging on this is quite clearly geared towards the prospect of more stimulus to defend 5%. So this is the state we're in. Emily, thank you very much indeed for that. Now turning to the macro picture in India, lots of data to chew on. Inflation in March slipping to over 5-year lows. Headline CPI eased to 3.34%. A Reuters poll was expecting it to remain flat at 3.6%. Thanks to moderating food prices, now giving the RBI some room to further cut the benchmark repo rate. Wholesale inflation also easing to a 4-month low in March, coming in at 2.05% compared to 2.38% in February. In the meantime, India is forecasting above average monsoon rains this year. Remember, the Indian economy relies heavily on these June to September rains to water crops and recharge reservoirs. On the trade front, Indian Trade Secretary saying the country is opting for a path of liberalisation with the United States. The two economies signing the terms of reference for the first part of a bilateral trade deal. Virtual negotiations begin this month, while in-person talks will be held in mid-May. India is racing against time to sign a deal, a trade pact with the United States during the 90-day tariff pause period. Right, let's get a steer on the regional economy and India's economy. Bring in Chetan Iyer, now Chief Asia Economist at Morgan Stanley. Chetan, great to have you on the programme. Let's start with the tariff differential, 26% for India versus 125% for China. Ultimately, does that work in India's favour? And if so, what kind of tariff arbitrage, competitive manufacturing advantage and possible FDI inflows could that yield?
So, Sri, I would say that, from a near-term perspective, actually, as everybody has been saying, there are no winners in this trade tension situation. So when you are seeing this kind of uncertainty, there is going to be a global slowdown. It is going to affect every corporation in the region in terms of their decision-making for new investment. And so there is going to be a overall trade slowdown, which will mean that India will also see a slowdown in exports. But over the medium term, yes, if tariffs differentials persist at that higher level for medium term, that will definitely have India some opportunity in terms of getting more market share in global goods exports, particularly electronics.
Chetan, how much is riding on the India-US bilateral trade agreement? And it seems that India is in front of the queue here for the United States. Is there any guarantee that if it is successful, if it is finalised and 0 for 0 tariffs are part of the deal, then 6.7% headline GDP for India is then guaranteed?
So look, I'll answer the last part first, and with the same framework that I answered the previous question, is that what we are saying is that from my 2018-19 experience, in fact, if I just take a step back, what we were doing at that point of time, Sri, is looking at the tariff impact on every country's growth on the basis of how tariffs lift prices and how volumes react to increase in prices. But what really happened is that the bulk of the impact to growth came from the fact that corporations across the world took a backseat in their investment decision-making, and that caused a global capex slowdown. A global capex slowed from 7% in first quarter of 2018 to just 2.4% by third quarter of 2019. And that affected everybody in the region. Everybody's exports got hit. Every country's corporations actually took a step back and did not invest. So you got an export slowdown, you got a capex slowdown, and that affected India too. And I think something similar will happen. So we have just cut India's growth estimates from, what we saw in the fourth quarter last year was 6.2. Yes. We see this slowing down to 5.7. And India will be better than the other economies in the region, but it will also see some downside.
Understood. Chetan, the other complication here is, and you've highlighted this, sectoral tariffs. And the path for sectoral tariffs, you say, is unclear. Many IT services are exported to the United States. So sectoral, on top of the headline 26% tariff, if it stays, does that imply that TCS and IT services exports broadly are more at risk than initially estimated?
Well, so far we haven't heard anything from the U.S. administration referring to services exports. So at this point of time, we are assuming that IT services exports will be out of this tariff's purview. Of course, things can change, but at this point of time, we think that the services exports, including the software services exports, will be left intact. So we are only worried about, from the sectoral tariffs perspective, the big area that India will face is pressure from the pharmaceutical tariffs, if those come through.
And we've seen the listed pharmaceutical sector trying to price that. Chetan, you also make the point that we think uncertainty is likely to linger for longer and will keep weighing on the business cycle. So from a sentiment and confidence point of view, what does that mean for corporate India? And is that likely to show up in the next set of earnings? And how high would you say the guidance risk is in this environment?
So we think that there is a downside to corporate India from exports. And just like every other country's corporations, even the Indian companies will be held back a bit. The good news for India is that there is strength in domestic demand, and India's dependence on net exports as a driver to its growth is less than everybody else in the region. So if you just were, I haven't looked to the China first quarter numbers, but the fourth quarter numbers showed that China had about 2.5 percentage points of its growth coming from net exports in fourth quarter out of total of 5.4. So about 45% of its growth came from net exports, whereas India has been running current account deficit. So it's more domestic demand oriented. So the corporations in India can have some confidence that there is confidence in the demand outlook, particularly the domestic demand part. And the government has also been implementing big investments. So that will also help the corporate sector to continue with some kind of capex in their economy.
How favorable is the pricing environment for oil for India's macroeconomic outlook, Chetan? And where then should that leave India's subsidy program?
So at this point of time, the government doesn't have too much subsidy. So what they have done when you saw this oil price fall, they have tried to increase excise duty on fuel. That will give them higher revenue. So the increase in revenue with the increase in fuel prices that they took up a few days back is about 0.1% of GDP. So it's a small number, but if oil prices continue to decline, then they can collect some more revenues through that route. So, yeah, I think lower oil prices is helping government to manage its public finances better, and which is the reason why, despite this growth slowdown that we are building in, we think government will be able to keep on its fiscal consolidation path that it has highlighted in the budget. Because there will be some loss in tax revenues because of economic slowdown, but then they have this offset from fuel taxes that they can collect and still keep that target of fiscal deficit that they have.
Chetan, we'll get on to government capital spending in a moment, but if we can turn to private capex and inflows and China plus one, that narrative combined with Make in India, does that get added momentum in this environment? And where then does that leave FDI inflows?
Yeah, I think, as I was mentioning earlier, if tariff situation for China doesn't come back to reasonable level, even if they, let's say, reduce it back to 34%, and then, mind you, there is an existing tariff of about 11% from 2018. So even if the U.S. administration reduces tariff to 34%, China will have something like 45% tariff. So that will make it, that will pressure corporations globally to think about outsourcing or not moving the manufacturing to some other parts of the region, including India. So that will be a measure that we should be watching for. But as I was mentioning earlier, I think that this will happen with a 12 to 18-month lag. And again, going by my 2018 experience, that in the immediate aftermath, because there is a global slowdown and there is a demand slowdown for every product, no corporation wants to invest on the face of a demand slowdown and try to diversify their supply chain. So yeah, in the near term, no big increase, but in 18 to 24 months' time, you should see the benefit of that coming through in form of greater investments in India.
Chetan, is this an opportunity for India to fast track and evolve from merely IT services to semiconductor manufacturing and this ambition to be a global semiconductor powerhouse? And are we seeing the necessary reform impetus from the governments to do so?
Yeah, so government is working on both semiconductors and the broader electronic supply chain. But, semiconductor business is not easy. It takes a number of years for you to start a fab and then at the same time be in the advanced chips. So I think that one is an effort that the government can make, but there will be certain amount of challenges which will be inevitable. But I think it's the electronics supply chain where they can have some success, and the government is working towards it. In a report that I wrote recently, I was highlighting that the next level of reform that India needs to make is at the state level. They need to take some serious measures to improve, ease of doing business. Because what happens is right now the government has made all the changes in law that they need to make at the central government level. But at the state level, because that is where eventually all the factories will be set up in different states. And those state governments have to ensure that they improve their ease of doing business, i.e. reduce bureaucracy, remove regulations, and try and get more investments going. It's happening in a few states. But if India needs to really find jobs for all that addition to working age population, they need to be a bit more aggressive at the state level. And maybe the federal government has a role in that to play by providing incentives for the state government to make that change.
Interesting. And the issue that was so starkly defined by the election was this issue of youth unemployment. So if we see these inflows, if we see all the necessary adjustments and reforms that you mentioned in terms of the ease of doing business at state level, do you think that there will be more jobs created for India's youth?
Absolutely. I think that is the most important measure they need to take to ensure that they create enough number of jobs. But then bottom line should be the effective translation of those reforms into GDP growth. Because ultimately India needs something like 8% GDP growth to keep the new addition of the workforce employed. But then remember, in the last few years, the addition of workforce has not, all of them have not found jobs. So you have a backlog of unemployment that also needs to be addressed. And so if you want to achieve that as well as new addition to workforce, they need to target something like 10-12% real GDP growth. So yeah, all those reforms have to be eventually translating into strong real GDP growth to ensure that you find enough jobs.
Let's take a look at the policy reaction function, Chetan. And where does all this leave the RBI, and how pronounced do you think the easing cycle will be, and have policymakers done enough to keep the banking system well-oiled with liquidity?
Yeah, so I think that is the liquidity injection bit is work in progress. But just in terms of framework that where we are thinking about the policy response this time, across Asia ex-China, we think that monetary policy will have to do the heavy lifting. Because post-COVID and even during 2018 period, everybody has used fiscal policy a bit more aggressively, and public debt to GDP ratios have gone up quite a lot across the region, particularly in India as well. India's fiscal deficit has been narrowing, but it is still sitting at 7.7% on a consolidated basis, state plus center taken together, which is relatively high. At that rate, it is going to still create pressure on its debt to GDP to go up, public debt to GDP to go up. So we are basically making an assumption that it won't be the fiscal policy that will be used more aggressively. It will be the monetary policy. And monetary policy front, we've already seen RBI cutting rates by 50 basis points. We're expecting another 50 basis points in the next two policy meetings.
Final question, Chetan. Balancing fiscal discipline with possible stimulus measures if the global economy does go into a meltdown because of the tariffs. How are policymakers in India going to address what could be a major dilemma for them?
Well, I think if you do see a global recession, and I would say even the U.S. economy going into recession, and therefore there will be even greater pressure than what we have built in right now, then the government will use the fiscal policy. I think first step would be not to take up that consolidation that they have planned in the budget. And the way they would sort of stimulate the economy is to increase capital expenditure. So that's in our risk scenario, and we would expect that RBI will cut even more, maybe another 50 basis points in addition to the 50 basis points we have in our base case. So we will see more coordinated monetary and fiscal easing effort, and they have the room to do that if there is that global recession.
Chetan, on that note, we will leave the conversation there. Thank you very much indeed for joining us with your insights on the outlook for India's economy at this very fragile time for the global economy. Chetan Iyer there from Morgan Stanley. Still to come.
We are very proud of what India has done. But are we the best in the world as yet? Not yet. Should we aspire to be? Or are we going to be happy being delivery boys and girls?
That was India's Trade Minister Piyush Goyal a few days ago musing about India's new age companies and if they hold up against their global peers. We'll discuss that with Indian PE company Chris Capital coming up on Inside India. Welcome back. You're watching Inside India. Some of the stories we're keeping tabs on. Pakistan getting a ratings upgrade from Fitch. The ratings agency now rates the South Asian nation as B- from ACCC plus earlier, with a stable outlook. Fitch citing fiscal consolidation as the reason. And bad news for Nvidia. The chipmaker says it will take $5.5 billion in charges after the US Commerce Department limited sales of its H20 chip to China. And Japanese multinational Suntory Holdings sees India as the best spot amid the tariff anxiety. CEO of the global beverage leader told us they will move to India.
We will move to India. India is now enjoying the best spot in this tariff situation. So India is a very important country for us too.
And we are keeping track of auto stocks in Japan amid all the tariff headlines. Lin Lin's been watching the space and joins us now for an update. Hi, Lin.
Yeah, good morning to you, Sri. When we look at some of the reports that's coming out about the Japanese automakers, they're highlighting two key points here. One is just how disruptive these auto tariffs have been, and two, how potentially transformative to that global supply chain these tariffs will be as well, keeping in mind that the US market is absolutely pivotal for the Japanese OEMs, particularly as they have been losing market share in China. In terms of the reports, and bear in mind they are unconfirmed at this stage, number two there in Japan, Honda reportedly considering scaling up assembly of US sold vehicles to up to 90% over the next 2 to 3 years, and that includes its CRV, its Civic, its HRVs as well. So part of that will certainly be utilising some of that capacity at the moment in the US, and the other part potentially looking at some of these new investments as well. Nissan, on the other hand, is looking at the moment to potentially scale back its Japan production for its top-selling US vehicle, which is the Rogue SUV, for the May to July quarter, and then sort of holding pat to see what comes next in terms of Trump's policy in terms of these tariffs. So again, what this highlights is that you've got some of these automakers, Sri, on the sidelines as they wait for more clarity here, keeping in mind that he has sort of flagged that there could be potentially some sort of a reprieve, although we don't have the details. But also, of course, even if we are talking about scaling up some of that capacity in the US, Sri, that's going to cost a lot of money and potentially going to mean that in the coming quarters, we're going to see that price tag in the US going up for vehicles. And then, of course, it's going to be about diversification of markets, India potentially one of them as well.
And sometimes they're not shovel-ready projects, and it takes 3 to 4 years to get a factory up and running. Lin, thank you very much indeed for that. Right, China's coming up next. China's President Xi Jinping is on his Southeast Asia tour, bolstering relationships with allies. We'll be live in Putrajaya, Malaysia, next. Welcome back. Asian markets are broadly lower, despite the fact that we saw 5.4% Q1 GDP from China, which was surpassed expectations, actually. But maybe the sense in these markets is that this is a last hurrah. This is as good as it gets. And this is evidence of peak front loading, perhaps, before the numbers and the macroeconomic picture really starts to head south because of the tariff uncertainty and the hit to exports and supply chains. Elsewhere, let's take a look at the Indian market and what to expect. We're about 15 minutes away from the open. Nifty futures are suggesting an opening number in the region of 23,300. So let's call it flat to slightly lower for the Nifty 50. Dollar rupee also relatively stable at 85.61. Now, as India works on a trade deal with the United States, China is working on finding allies in Asia. President Xi Jinping is in Malaysia now in the second leg of his Southeast Asian tour. JP Yong has been leading our coverage there and is in the administrative capital of Putrajaya. Great to see you, JP.
Great to see you as well, Sri. Good morning to you guys. And yes, busy day for Chinese President Xi Jinping. We do know that he is currently, or did come from the Istana earlier on today, to meet with the Agong, or the elected king of Malaysia, for a meal, possibly brunch, really, to talk about state affairs. And it's also important to note that his visit to Malaysia is on the invitation, apparently, of the Agong. But he is going to meet later in Putrajaya at the Prime Minister's complex, just over my shoulder here, with Prime Minister Anwar Ibrahim, and that's where the deal making and a lot of the relationship forging takes place. Actually, we have to remember that China in the past, and Chinese President Xi Jinping in the past, has also welcomed Malaysia's aspirations to join BRICS, actually one of the member country blocs, in an effort to try and broaden their economic relations with other areas. And now with the tariff and protectionism policies from the United States, it might make it more imperative for Malaysia to do such. And this could also lead to more realignments and more relationship building with other countries also because of these issues, and could also set a trend or a precedent that could also include the likes of India, which might have a role to play in this new realignment, especially in this tariff order. I do want to talk about this with our next guest, Tricia Yeo, who is an associate professor at the University of Nottingham here in Malaysia, who also follows a lot of these policies and also a lot of these realignments as the board reshuffles in light of all the developments of 2025. Tricia, thank you so much for joining us this morning. And again, a momentous time, actually, apart from the fact that we are seeing deeper ties between Malaysia and China. Could this also see Malaysia perhaps get closer to other blocs like BRICS?
Hi, JP, and thanks so much for having me this morning. That's precisely right. The President Xi Jinping's visit, which is being seen as a sort of charm offensive in the region, it's a very strategic timing as Malaysia is the chair of ASEAN. Just specifically to answer your question as to what alliances Malaysia will be seeking from here onwards, of course, on the back of the reciprocal tariff announcement, Malaysia has always looked to ASEAN and hoping to always get regional integration. So ASEAN will be the primary market that they're looking at, but they will also be looking towards other countries, and BRICS, of course, is one that Malaysia has already signed up to for BRICS Plus. But as of last year, Malaysia has said it also wants to subscribe to BRICS, which it also argues does not necessarily go against the principle of ASEAN centrality, which is neutral, being able to negotiate with both blocs from the East and the West. But certainly moving forward with Xi Jinping's visit here to Malaysia, I do think that we're going to see a lot more of these alliances and bilateral ties strengthening in the next few months and years to come.
Yeah, absolutely, Tricia. And I think one thing we're also watching out for is the fact that Malaysia is trying to build these relationships by also trying to stay neutral, at least trade neutral, between various major countries, including that of the United States. But I'm sure you've noted also over the last couple of days that the Trump administration, or U.S. President Trump, has also said that he thinks China and Vietnam, at that instance, were trying to screw the United States of America. And a lot of this very irritated language, at least, from the U.S. might make it more difficult for Malaysia to maintain that trade neutrality as it builds these relationships. Again, how much trickier is it now for Malaysia to do so as compared to, say, 5 years ago?
I mean, it is tricky and it is getting trickier, but I think we would also note that this particular visit was planned way before Trump's reciprocal tariffs were announced. It just happens to be that it comes at the time just after the tariffs were announced. So speaking to the fact that the U.S. is still a really important market for Malaysia, just to note that in 2024, the U.S. actually became the second largest export market for Malaysia, and number 3 is China. So yes, while China is the biggest trading partner, U.S. is still a huge market for the country. Malaysia is hoping to send its negotiators to Washington, D.C., and Malaysia has always applied this principle of neutrality. It is getting more difficult as of course, these policies are seemingly very inconsistent, and the inconsistency itself would make Malaysia and other Southeast Asian nations, I would argue, put them in a very difficult position to rely on the U.S. as a reliable trading partner. But nevertheless, I do think that if Washington, D.C. is continually open to discussions and negotiations, we do hope that we will be able to still maintain good relationships with both sides of the divide. I mean, honestly, the economy depends on it. And I think the other aspect that's not really being discussed is the security aspect as well, where the U.S. would not stand to gain from losing allies within this region.
Right. You mentioned a while ago that the U.S. is the second largest export market for Malaysia. That means also you're very vulnerable actually to these tariffs. Is it better for Malaysia to try and at least improve those trade relations with the U.S., or perhaps more important now than ever to try and diversify away from the fact that they're so exposed or vulnerable to the U.S. as that important export market that you highlighted?
Sure. I mean, Malaysia has always seen itself as a relatively small, open economy. I mean, others would disagree that it's actually necessarily small, but whatever the case, we've always been in this geostrategic, geoeconomic, geopolitical area of the world. We've historically been known as a trading entrepot between the different parts of the regions of the world. And so we will continue to want to seek the best optimum strategy and what's the most strategic outcome for the country with all countries. But as you say, that, if these tariffs actually do go through. So Malaysia has been hit with 24%. And although the semiconductor industry has been sort of paused for a moment, we don't know very much whether tariffs are going to be imposed on that. Because semiconductors, Malaysia exports, I think, about 20% of the US semiconductors imports altogether. If that were to happen, that would increase the vulnerability even more. But to answer the question about whether we need to be looking for new markets, I mean, that's absolutely true as well. I do think that as we are speaking, policymakers and government agencies alike are already scrambling to think of new ways to bring in new markets, and possibly in regions that perhaps had not concentrated on before, perhaps in Africa, perhaps in Latin America, perhaps in the EU. I mean, but it's clear that new strategies, fresh strategies, not just within Malaysia, but ASEAN as a whole, need to be thought of as we navigate these tumultuous waters in the next couple of months, or up to the next 4 years, perhaps.
Right. Is India a possible place where there's a lot of opportunity? Because it has been sounded out by Prime Minister Narendra Modi in Bangkok when he visited them for the BIMSTEC summit that there is an openness or an interest actually to revising and loosening the ASEAN-India free trade agreement. Does this create an opportunity for India and ASEAN perhaps to serve each other's better interests now?
Well, absolutely. I mean, I think along the lines of thinking of new markets, India-ASEAN Free Trade Agreement had already been signed in 2009. So you've got like a number of years. We've had a strong relationship as well. Malaysia itself has a strong relationship with India, both countries being former Commonwealth countries. Our constitutions are based on the same model. So there's a lot of historical goodwill and cultural ties built in already. India, of course, itself is an Asian country. So there are some cultural values that are shared. But I do think beyond India, there are opportunities not just for the ASEAN region to look at just the Asian markets, but beyond, as I insinuated earlier. And the good thing, for example, is that specifically speaking about Malaysia, Malaysia has also restarted its negotiations with the EU on the Malaysia-EU free trade agreement, which has been stalled for over a decade. A lot of areas like palm oil have been sorted out. So hopefully we will see some productive measures coming out from these FTAs as well.
So you're seeing ASEAN as a group becoming a little more aligned with China. They're now open to actually working more closely with India. And again, all these opportunities are rising because of the reshuffling that the tariff and protectionism policies have actually brought to the table. What about a near future where you see more collaboration or closer integration between India and China? We know that these two countries are emerging, but also have a bit of a checkered past as well, Tricia.
Yeah, they do have a checkered past. And I think, it's really not been very long since the Trump administration has come into power. And so the reshaping of these relationships and these, perhaps formerly fractious relationships, that will solidify moving forward. I do think that India and China will possibly set aside some of the differences that they have in order to think about how to collectively come together. I mean, Asia as a whole, we know, contributes a great deal to the supply chains around the world. So it really is in the best interest, and I think this is an argument that needs to be made. It's in the best interest for, firstly, ASEAN countries to work together, as has been the case. I mean, we saw the announcement last week after the economic and trade ministers had a meeting where, as a region and as a bloc, they will be coming together and again promoting and a renewed sense of commitment to a multilateral rules-based order. And ASEAN and Asia, so the larger Asia-Pacific region, needs to think about how they can no longer be self-interested and, for example, not think of new unilateral tariffs or other forms of non-trade barriers or non-trade measures that will protect their own countries, but really think about how do we do this collectively as a region. I just have to also say that traditionally ASEAN is not so aggressive in that sense. So this is the time that both ASEAN and the Asia-Pacific region, particularly China and India, as you point out, really need to think about collective interests at this time.
And opportunities to form new alliances as the world order reshuffles amidst this evolving tariff policy and new protectionism that's been rising. Tricia Yeo from the University of Nottingham in Malaysia, thank you so much for joining us today on Inside India. We throw it back to you guys at the studio, Sri, but a lot more coverage, at least, as the visit of Chinese President Xi Jinping in Malaysia transpires and continues to unfold throughout the day.
And it's a fascinating, perhaps inherent tension, isn't it, JP, between India and China and the formation of these alliances. They were always doing it, but it's taken on a greater urgency. And I wonder, when you have these two regional, if not global, economic powers stomping around effectively in Southeast Asia, whether there are going to be any problems that may arise out of that, whether it's from a territorial point of view, or whether it's from a perception point of view of China pushing the BRI agenda and India perhaps forming a partnership with RCEP or even CPTPP. Are you getting any sense that there could be some unintended consequences here?
I think right now, Sri, that there's a lot of interest that's being expressed at the moment to opportunities to form these alliances, to join these big trading blocs that perhaps weren't there because of the impetus from these trade policies. But as you mentioned, there's a lot of cultural baggage, perhaps, or historical ties that might be brought up, or perhaps pains or wounds that have to be overcome. But again, this could be the impetus to actually overcome those and move forward to forge new alliances.
Exactly. There's even a conversation about Chindia, about the dragon and the elephants doing a dance together. So we'll look forward to that particular tango. JP, thank you very much indeed for that. We are counting down to the market open in Mumbai. We are back in 2 minutes. Welcome back. Indian markets still in the pre-open stage, and let's give you a sense of what to expect. They are open now, actually. Right, Nifty 50 at 23,295 or thereabouts, so flat to slightly lower. Dollar rupee is somewhat weaker at 85.53.75, so Indian rupee looking slightly firmer against the US dollars. Take a look at how some of the IT majors are opening in trade today. Wipro reports quarterly earnings later today. Shares ahead of that are on the defensive, down just marginally by about 50 basis points. IT services giant is expected to show modest growth trajectory with flat margins. Infosys reports tomorrow, and the shares are sliding down by 1.2%. Analysts will be closely watching guidance from these IT majors considering their vulnerability to US tariffs. Now, we mentioned the startup environment in India. Earlier this month, India hosted a startup event called Mahakumbh, highlighting innovations from across the country. At the event, Trade Minister Piyush Goyal flagged how Indian companies are turning more service-oriented. He threw up a comparison with China and urged India to aspire higher.
What are India's startups doing today? We are focused on food delivery apps, turning unemployed youth into cheap labor so the rich can get their meals without moving out of their house. And against that, what does a Chinese startup do? Work on developing electric mobility, battery technologies. And with that, they're today dominating the electric mobility ecosystem. We are very proud of what India has done. But are we the best in the world as yet? Not yet. Should we aspire to be? Or are we going to be happy being delivery boys and girls?
Despite the conundrum around services versus manufacturing in new age companies, the private equity market in India still seems to be robust. Recent report by Bain observed slumping deal-making activity in APAC region last year. However, India emerged as the bright spot for PE firms in 2024. Firms like Chris Capital are seeing high interest for their India-oriented funds. Reports say they recently raised over $2 billion for their latest private equity fund. That's one of the highest amounts ever raised by an Indian buyout shop. Right, I'm delighted to say Kunal Shroff joins us now, managing partner at Chris Capital. Kunal, great to have you on the programme. Can we start with those controversial comments from Commerce Secretary Piyush Goyal? Are startups turning India's youth into cheap labour when they should be empowering and innovating is his point. As far as the startups and the portfolio companies that you're engaged with, are they showing any sign of innovating and moving up the value chain?
Sure. First of all, thank you for having me here. I think it's a good question. I think I would say that instead of saying, should we be doing A or B, I would say that India needs to do A and B. So there's a lot of opportunity in India. The good news is it's a large domestic consumption market. So you can clearly use globally, global best models to say, why don't we try and, attack India using those? And at the same time, India has a lot of talent on engineering, chemistry, a variety of different skills that it can use to become globally competitive. So I'll give you an example. India has been known on the enterprise tech space more for IT services. But if you look in the last 5 years, there have been really world-class SaaS companies coming out of India as well. So I think it's going to be a journey. And I think India has a lot of potential to capture some of that and go up the value chain over this decade.
And to what degree, Kunal, does government play a role? Or let me rephrase that question. What does the government of India need to do? Or rather, what is the right policy framework to make it, for example, a global semiconductor powerhouse?
Yeah, so I think some things are easier than others. India has obviously found it easier in services, and manufacturing requires a lot more on-the-ground support. You need, power costs, logistics costs, taxes, labor, a lot of other issues that come into play. But the good news is I think the government is seized of that. They have been working on production-linked incentives, for example, for some time now. Apple is a great example, which everybody is aware of. The amount of production shift that has happened towards India is a great example for other companies to try and emulate that. So I think there's a lot of potential on the manufacturing side, but it can't happen overnight.
Kunal, let's talk about the largest ever Indian buyout fund that you just raised, that $2.1 billion. How are you going to be deploying that capital?
Yeah, so I think I'd like to talk more in general terms rather than the fund itself, because I'm not allowed to comment on that. But overall, if you look at private equity in India, you've got three, four factors that are working really in favor of it. One is you've got India itself that is growing on a nominal basis in double digits. It is more shielded from all the tariff noise that you see all over the world. For example, India's exports to the US account for roughly 2% of GDP. So it's a country that's a lot more resilient, has a lot of consumption domestic that you can target. When you think about the size of the market, it's about a $40 billion annual market, which is quite large, but ends up being roughly 1% of GDP. And therefore, the private equity market has been growing much faster than nominal GDP in India. When we think about our opportunity space in the private equity landscape, what we see is companies are willing to engage a lot more with private equity today than maybe 10 years ago. There's been a lot of maturing in the landscape. Entrepreneurs are willing to collaborate with private equity. Value creation has become paramount. And so what you're seeing practiced today in India is a lot similar to the way it was practiced in the West. And I think that's very encouraging, because what we have seen in our portfolio is companies that are reasonably well run are still companies where you can implement various value creation playbooks to improve them further. You can improve sales productivity, you can improve their margins through procurement, you can really help them on capital allocation, which is one area where a lot of the high return on capital companies haven't been as aggressive as they can be. And so there are multiple levels on value creation, and that gives us the most excitement over the next decade.
Kunal, and in terms of exit strategies, and let's move on there, IPOs are not necessarily the only game in town, but market uncertainty has made the IPO option far more challenging, plus valuations have come down in some areas. How would you characterize the IPO pipeline in the next 6 to 12 months?
Yeah, absolutely. Very good question. I think last year, even the year before, were reasonably good years for exits for private equity and for IPOs in general. I think it is getting more challenging now. The market is going to be more discerning about the types of companies that go public. From our standpoint, I think there are two aspects. One is the here and now, and one is the long term. When you look at the here and now, I think you're absolutely right. It may be choppy. It may not be as easy to go public this year. There are additional avenues of exit that are available, because there are lots of global and regional funds who are looking to invest much larger dollars in India and would be happy to invest more, just as they tilt their focus on India. Everybody's India appetite is going up. And on the longer term standpoint, I think the domestic market is really deepening. So about 10 years ago, the foreign institutional investors, or FIIs, would control the movements of the markets. If a company was to go public, you'd really need their support. Today, that's not the case. It's inverted. Domestic savings has really moved into financials, and within financials into equities. That's really supporting the domestic market. And as you can see, whenever there's a global shift in capital, India still ended up being a lot more resilient. Same is true for IPOs. Today, if you were to go take a company public, the entire book can be built just with domestic support. And I think that's very encouraging from a longer term trend line, and very encouraging for private equity exits in the future.
Kunal, from Chris Capital's point of view, can a national stock exchange IPO wait? And are you happy keeping your minority stake in the NSE in the $700 million continuation fund? And is that the best way to unlock value and returns?
So that's a good question. We did this continuation fund last year. It was one of the largest in India as well as in Asia. And it's been a great investment for Chris Capital so far. It's been a great investment for most people who've been invested in it. And we are hopeful that there will be an IPO at some point. Our investment thesis is generally a 5-7 year period, so we can be patient about the development of it. And there are two aspects to it. One is obviously an IPO would unlock value. But there is a domestic market at the same time, a private market, I mean, at the same time, if you do need liquidity for those who need that liquidity. The broader point, though, is it's a great derivative play on India. So as global investors get bullish on India, we believe NSE is a direct beneficiary of additional IPOs, additional capital coming in. Yes.
We'll leave it there, sir. Thank you very much indeed for joining us. Access Middle East is up next. Have a good day.